Welcome to The Explainer. If you've ever felt completely overwhelmed by financial jargon, or honestly, if you're just looking for a rock-solid, foundational tool to truly understand how a business works from the inside out, you are exactly in the right place. Today, we're demystifying one of the absolute most critical documents in the entire business world.
Think about that for a second. What if one single piece of paper could instantly reveal whether a business is thriving and healthy or quietly heading straight toward financial disaster? I am talking about the balance sheet. Once we understand how to read this one single document, it permanently changes the way we look at any business.
Okay, let's dive into this. I want you to imagine that your business is a house. Now, a balance sheet isn't a video showing that house being built over the course of a year. No, it's a photograph. It's a precise snapshot of that house's condition on one specific day. It freezes time. It shows exactly what's holding the house up and what's weighing it down at that exact moment.
Here is our blueprint for today. We'll start with a snapshot, move to what you own, what you owe, and what is yours. Then we'll put the formula in action and wrap up with why it matters. Let's get to it.
Section 1. The snapshot.
Every balance sheet answers three incredibly basic questions. 1, what do you own? 2, what do you owe? And 3, what is actually yours? Honestly, if you can just memorize these three questions right now, you have already conquered the hardest part of financial literacy. Own, owe, yours. It's a rhythm, and it applies to a multi-billion-dollar corporation just as much as it applies to a corner lemonade stand.
Section 2. What you own, your assets.
So what are they? By definition, assets are everything your business owns that actually has value and helps generate future income. Think of these as your tools. This is the ammunition your business uses to operate every day, serve your customers, and ultimately earn money.
But what does that actually look like in practice? Well, it's your cash on hand and your bank balance. It's the physical inventory sitting on your shelves. It's the equipment, the office furniture, the buildings, and the company vehicles. It even includes the money that customers still owe you for services you've already delivered. Yeah, we're looking at you, Dave. It's down to pay that invoice. All of these things have real, tangible value to the company.
Now, what's really interesting is how we categorize these based on time. Some assets are quick, like cash or inventory that we expect to use up or sell within a year. We call those current assets. Others are things we're going to use for years and years, like heavy machinery or a building. Categorizing them this way instantly tells anyone looking at the sheet exactly how much quick cash the business can get its hands on if it really needs to.
Section 3. What you owe, liabilities. Simply put, liabilities are the debts and financial obligations your business has to pay to outside parties. If assets are the tools you use to make money, liabilities are the promises you've made to pay other people for providing you with the capital, goods, or services to get those tools.
And this is completely grounded in everyday reality. If you take out a bank loan to start your business, that's a liability. When your suppliers send you a bill for materials, liability. It includes your business credit card balances, the salaries you got to pay your employees at the end of the week, and yes, for sure, the taxes you owe the government.
Just like with our assets, time plays a huge role with our obligations. We have immediate bills that absolutely must be paid within the current year. And then we have long-term liabilities, like a multi-year business loan or, going back to our metaphor, a 30-year mortgage on our house.
Section 4. What is yours? Owner's equity.
Owner's equity is the true golden nugget here. It is the value left over for the owner after every single debt has been paid. Think of it this way. If you were to sell off all your assets today and use that cash to pay off every single liability, whatever cash is left over in your hand, that is your equity. It's the portion of the house that you can truly, legally claim as your very own. Let's see how this builds with some super simple visual math. Let's say a business owns $100,000 in total assets. Now subtract the $40,000 in liabilities they owe. You're left with $60,000. That is the owner's equity. It really is just basic subtraction. This means the owner truly owns $60,000 of that business. Section 5. The formula in action. Let's put all the puzzle pieces together. Here it is, the big one. Assets equal liabilities plus owner's equity. This is the absolute, unbreakable law of the balance sheet. This equation must always, always balance. And it makes sense, right? Everything a company has, its assets, was either funded by borrowing money, which creates liabilities, or by the owner's own money, which is equity. That is exactly why it balances perfectly. And this brilliantly illustrates exactly how it works. If our total assets are $100,000, that bar's height must perfectly match our stacked liabilities of $40,000 and owner's equity of $60,000. It's like a perfectly balanced scale.
Section 6. Why it matters. Okay, first we have to clear up a massive beginner misconception. A balance sheet is a snapshot of financial health, but it does not show how much profit a business made. Profit is tracked on a totally different document called the income statement. A balance sheet doesn't care how much you sold last month. It literally only cares about what you own, what you owe, and what belongs to you today. Because it shows pure stability, it is the absolute go-to document for the most important decision makers. Investors look at it to evaluate a company's strength before buying stock. Banks demand to see it before they'll even think about approving a loan. And smart business managers use it constantly to make decisions and monitor growth. They're all looking for the exact same trifecta: strong assets, manageable debt, and positive equity. So the crucial point here is that understanding a business really just comes down to answering these 3 questions. What do you own? Those are your assets. What do you owe? Those are your liabilities. What is actually yours? That is your owner's equity. Master these 3 pieces, and you have a rock-solid foundation for reading any company's financial statements. Before we wrap up, I want to leave you with something to chew on. We've talked entirely about business today, but these rules apply to individuals too. If you wrote down the value of everything you own right now and subtracted every single debt you currently owe, what would your personal owner's equity be? If you pulled the balance sheet for your own life today, would you have a strong, stable foundation? It's a fascinating way to look at the world, and once you see it, you kind of can't unsee it. Thank you so much for joining me on this explainer today. Keep learning, and I will catch you next time.